So with all the volatility in the market right now, it can be really nice to own some dividend stocks that actually pay you cash even when the market is struggling. And many of these companies have not only been paying dividends, but they've actually been increasing these dividends for many years, even through recessions. Speaking of which, many people are screaming that a market crash is just right around the corner. And as a long-term investor, that's not really something that I lose sleep over. I'm still constantly investing in stocks. But if we do get a market crash, a lot of these stocks are actually going to be trading at much, much lower prices. And what happens with dividend stocks is that when the price goes down, the dividend yield actually goes up. And a lot of these stocks already have very attractive dividend yields, not to mention pretty attractive prices too with all the market volatility. But if we get that market crash, you could probably pick up some even better deals on some of these dividend stocks at really great prices with really high yields. So today I thought it'd be fun to take a look at some dividend stocks that I'm either currently investing in or that I'm currently tracking. Also some stocks that you guys have mentioned in the comment section as well. But just a quick disclaimer, I'm more of a dividend growth investor, which means that my stocks tend to have lower dividends. So their yields are usually between like 1 to 3%. I actually like some other stocks too that have actually lower yields than that like lower than 1%. A couple that come to mind is like Nvidia, Activision, things like that. But I did not include those in this video. And I know that some of you are dividend income investors, so I included some stocks with higher yields as well so that you don't feel left out. So there's going to be a lot of variety in this video. One more thing, I like to invest, when looking at dividends, I like to invest in very strong companies with very strong brands that have been around for a while and that are likely to not disappear in the future, because I want to continue to receive those dividends in the future. So a lot of these companies will be very popular. You've probably heard of all of them. So I apologize if you wanted some more risky, companies and stocks that you've never heard of that pay really high yields of like 7%, 8%, things like that. But a lot of those tend to be a lot riskier and their share price is usually trending downward. So I usually stay away from those. So I apologize if that's what you wanted, but either way, I do think that this will be a very fun video. We're going to take a look at a lot of stocks and I hope you enjoy this. If you do, make sure you hit the like button and stay tuned. Let's go ahead and get started. What's up everybody, my name is Ale and welcome to my world of stocks. So the way we're going to do this today is we're going to take a look at 8 different dividend stocks. I actually wanted to do 10, I wanted to do even more, but the video would just be way too long. So we're going to do 8 stocks. We're going to take a look at their dividends, their price performance, and I may even give a couple reasons why I like the company as well, because that's also very important. And then at the end of the video, I'm also going to include some honorable mentions because I wanted this video to actually be longer, but I didn't want to make it too long. I didn't want to bore you guys. So anyway, with all that said, let's go ahead and get started. Okay, starting with stock number 8, we've got PepsiCo, ticker symbol PEP or just PEP. This is the company that owns Pepsi. They also own very big brands like Gatorade, Mountain Dew, Aquafina, Tropicana, Naked Juice, Rockstar, and even some non-beverage brands like Quaker and Frito-Lay, which includes Lay's, Doritos, Cheetos, Tostitos, Fritos, and Ruffles. And looking at their price performance, they've been pretty steady in the past 5 years, but are only up around 30%. But in the past decade, their performance improves to over 150%. Still, PepsiCo isn't really recognized for its future growth as much as its stability and reliable dividends, and luckily, they deliver in both of those departments. In fact, they currently have a dividend yield of over 3%, paying $3.71 per share, and they have an absolutely massive growth history of increasing their dividends every single year for the past 46 years. That is massive. And while their 5-year growth rate is only in the single digits, I still consider it reasonable at over 8%, and their payout ratio isn't too bad either at 65%, although I typically like it to be lower than 50%. Now, I've never invested in PepsiCo myself because I've been worried about consumers moving away from sugar and artificial sweeteners, and I'm also more of a growth investor, and PepsiCo doesn't really fit my specific criteria. In fact, they've only grown revenue by a couple % last quarter, but on the other hand, EPS did grow by almost 20%, and they've been making moves to diversify their options to include healthier alternatives like juices, waters, things like that. They also include smaller portions. And on top of that, in my opinion, they made a very good acquisition in SodaStream. So they acquired SodaStream, which sells products that let you convert water at home to carbonated beverages. And SodaStream actually saw their revenue jump by over 30%, and net income jumped by over 80% in their last quarter that they reported. So this new acquisition may help PepsiCo enter a new market, which is kind of the home, kind of creating a carbonated beverage market. So that lets them enter a new market. And because SodaStream has been performing so well already, now that they're getting backed by a huge corporation like PepsiCo, I think they're just going to continue to have even more success in the future. So, with those really nice dividends that PepsiCo is already paying out, I think PepsiCo is actually looking pretty attractive right now. Okay, moving on to stock number 7, we've got my second largest stock in my entire portfolio. This is a stock that I am extremely bullish on, and that is Microsoft, ticker symbol MSFT. And I should clarify, bullish in the long term, because anything can happen short term. And I know a lot of people will get very angry at me if any of these stocks kind of drop in the short term, but long term, Microsoft, such a good company. Now their dividend is very low at less than 2%, but they fit every criteria to be in my dividend growth portfolio, with a 5-year growth rate in the double digits at almost 14%, and their dividends are likely to continue to increase in the future thanks to a strong history of 15 years of growth and a low payout ratio at less than 50% at around 41% to be specific. On top of that, this has been one of the most reliable stocks out there, being up over 22% year to date, over 173% in the past 5 years, and they currently trade for around $100 per share. Now, Microsoft really needs no introduction, but some of the reasons why I'm invested in them include their cloud segment with Microsoft Azure, which is the second largest cloud platform in the world, only behind Amazon's AWS. They dominate the PC market with the biggest operating system in Windows. They offer tons of business solutions with Office 365. Many of their apps and services are also available on smartphones. They dominate the PC gaming market with Windows, and they compete heavily in the console gaming market with Xbox. They're even using Azure to stream video games out to your cell phone with Project X Cloud, which should be launching, I think, sometime next year. So a lot of analysts are actually calling Microsoft the next Netflix of gaming. We'll have to see if that plays out, but that is something to look forward to. And they even made some big acquisitions of LinkedIn for the professional networking market and GitHub for the coding and developer market. Not to mention that they even do a lot of work in artificial intelligence, augmented reality, and autonomous driving, which Microsoft Azure, some people pronounce it Azure, or Azure, I think, but I like to say Azure. It's actually being utilized again as the base for cloud and connected car services, which will be used by Volkswagen in over 5 million cars starting in 2020. So there's actually a lot of synergy within the company and their different products and services, with Microsoft Azure being a prime example of that. And this is a company that is really on fire. When looking at their results, their last quarter, revenue was up 19%, net income was up 34%, and EPS was up 36%, while almost all of their different products and services saw enormous growth, including Microsoft Azure up a massive 76%, gaming and Xbox was up 44% and 36% respectively, and LinkedIn was up 33%, and Office 365 commercial was up another 36%. So even though their yield is pretty low, this is a company that again is absolutely on fire, is already dominating in several different markets, and is still making acquisitions to dominate in new markets as well and keep that growth moving forward. So as a dividend growth stock, Microsoft absolutely fits the bill. All right, guys, moving on to stock number 6, we've got McDonald's, ticker symbol MCD. Now, this is a company, very interesting company, because I've actually never really been too bullish on McDonald's. I've always been scared about, people moving towards a more health-conscious future and staying away from a lot of these junk food places. But so far, I have been completely wrong on McDonald's. I mean, they've performed very well. And I know that a lot of my viewers really like McDonald's, so that's why I included it in this list today, because a lot of my viewers are actually invested in McDonald's and they always want me to talk about it. Now, when looking at their price performance, they've almost doubled in the past 5 years. And despite recent volatility in the market, they're still up over 6% year to date. And so they're currently trading close to their 52-week high at over $180 per share. Now, when looking at their dividends, they have a decent yield of over 2.5%, a reasonable payout ratio at under 60%, a pretty low 5-year growth rate of only around 6%, but an absolutely massive growth history of over 40 years, at 42 years to be exact. And the reason why McDonald's has had this really long growth history for those dividends is because the company has just performed very well. You know, when you look at the fast food market, McDonald's is just one of the most recognized brands out there. I think it's going to be very hard to find anybody who hasn't heard of McDonald's, if not impossible. So McDonald's is just this really strong brand that has been dominating for a very long time, yet they're still seeing a little bit of growth as well. In fact, in their latest quarter, global comparable sales increased by over 4% at 4.2%, which actually beat the industry average of 3.5%. And they saw positive comp sales in all of their different segments. And thanks to new innovations that McDonald's is investing billions of dollars in to modernize their restaurants with delivery options, digital ordering features, and their whole new concept and design called Experience of the Future, Mickey D's is likely to see that growth continue. Now, their new digital ordering kiosks may attract some younger customers to their restaurants, but even if they don't, their new mobile app may help increase orders. In fact, they have over 37,000 restaurants, so that very large footprint for McDonald's makes it ideal for delivery services through partnerships like the one that they already made with Uber Eats, and it gives them an overall advantage over their competition. Still, McDonald's is not really a company that fits my overall investing strategy because I like to invest in stocks that or companies that I actually use their product or that I at least like their product, and I don't really feel that connection with McDonald's. But McDonald's is a company that continues to prove me wrong, continues to perform well, and those dividends are actually pretty darn attractive. Okay, moving on to stock number 5. We've got a company that I've never personally invested in, but it's a stock that a lot of you guys have mentioned to me that you're invested in and that you've wanted me to talk about, and that is Verizon, the telecom giant, ticker symbol VZ. Now, their yield is pretty high at over 4%, and they have 14 years of growing those dividends every single year. And when you combine that with a pretty reasonable payout ratio at just barely over 50%, you essentially get a pretty reliable dividend that isn't likely to disappear anytime soon. However, their 5-year growth rate is too low for a dividend growth investor like myself at less than 3%. But taking a look at their stock price for the past 5 years, they've been kind of all over the place, but thanks to a recent rally in 2018, they've managed to finish up 16% in the past 5 years and up almost 9% year to date, currently trading for around $57 per share. And one of the reasons for that rally has to do with their performance. It's actually been pretty decent. Now, don't get me wrong, this is another slow growing company that increased revenues by only 2.8% year over year in their latest quarter. But thanks to tax reform, their EPS grew almost 25%. But more importantly, their free cash flow actually grew from $5 billion to $14 billion year to date and year over year. I know that's a little confusing, but just know that it increased by a lot. And the only reason why it isn't higher is because they've been investing so much money on their new 5G infrastructure, which is going to be a key component to their growth moving forward. Now, despite that recent rally, they're still pretty cheap with a PE ratio of only around 7. So in Verizon, I think you get the leading telecom in the country that doesn't necessarily have enough growth to attract an investor like myself. But for dividend income investors or value investors, this is a very stable company with over 116 million wireless subscribers that operates in a market that isn't going to disappear anytime soon when you consider how addicted we all are to our smartphones. And because they're already first to market with 5G networks available in LA, Sacramento, Houston, and Indianapolis, Verizon is in a good position to keep those subscribers and add to that number thanks to markets that are set to explode like the Internet of Things and autonomous driving. Having said that, I kind of like AT&T a little bit more just because they've acquired Time Warner to compete with Netflix and Amazon in the video on demand market. And they also have a higher yield of over 6.6% with a massive 34 years of dividend growth. And they even have a cheaper PE ratio of less than 6. But I already talked about AT&T in last week's video, and a lot of people left comments saying that they preferred Verizon over AT&T. So I decided to just include Verizon in this video. But either way, both telecom giants are absolutely on my radar, especially if they drop in price sometime in 2019, any kind of major event. They would look very attractive to me, especially with those really high yields increasing even higher. Okay, moving on to stock number 4, we've got Apple. Apple, ticker symbol AAPL. I know that's a little bit of a shocker. I feel like nobody ever talks about Apple's dividends because their yield is pretty low. We'll take a look at it in a second. But Apple is actually a pretty good dividend stock. And when you consider the fact that Apple has dropped so much in price recently, it's starting to look even more attractive. Now, they currently have a pretty low yield of less than 2%, but as a dividend growth investor, they look very attractive with a really low payout ratio of just a little over 20%. And their 5-year growth rate looks just as good, barely over 26%. However, they've only grown those dividends for 6 years, so the history could be better, but the low payout ratio and high growth rate tells me that it'll probably continue to go up over time. And thanks to the recent drop in price, Apple isn't even that expensive. This is Apple that we're talking about, and they have a forward PE of only 11. That's pretty crazy. And despite climbing over 100% in the past 5 years, they recently dropped by close to 30% from their recent high, which may represent a good entry point. Now, the reason for that drop has to do with their future iPhone sales looking weak. In fact, despite having an outstanding fiscal fourth quarter with revenue up 20%, EPS up 41%, iPhone revenue up almost 30%, and services up 17%, their stock still dropped because they announced weaker guidance than expected. iPhone unit sales were up less than 1%, and they announced that they won't be reporting unit sales for iPhones, iPads, and Macs going forward, which led investors to panic that sales are going to get dramatically worse in the future. Now, much of that was speculation until an Apple supplier named Cirrus Logic came out and lowered their guidance. Now, this is an audio chip maker that received over 80% of its revenue from Apple in fiscal 2018, and they lowered their revenue guidance by over 15%. So that definitely led investors to think that Apple's iPhone sales will be even slower than expected. Still, their services segment brought in $37 billion in their fiscal 2018, and analysts estimate that it'll be worth over $50 billion by 2020. And the reason why their services business is so important is because it keeps customers invested in the Apple ecosystem and drives product sales even further. Apple is also reportedly working on autonomous driving software and a new video on demand service, which could be potential growth catalysts in the future. Not to mention that Warren Buffett's Berkshire Hathaway owns a $46 billion stake in the company, and they recently revealed that they bought more Apple stock in the third quarter. So with Apple, I think that you get a pretty nice dividend that is set to grow even further in the future. However, I do also think that iPhone sales will probably slow down at least until 5G comes out, and that might not come out until maybe late 2019, 2020. And because iPhones are just so expensive as it is, I don't see a lot of reasons for customers to actually upgrade their iPhones when Android phones are actually so much cheaper. You know, I personally have a OnePlus 5, and I think it cost me like $500 around there. So about half the price of some of these $1,000 iPhones. And my OnePlus 5 has like 8 gigs of RAM, and it has a really good processor, so it's just a really good phone. So I just don't see a lot of people willing to upgrade their iPhones until 5G comes out. That could be a potential catalyst to get people to upgrade. I'm not saying iPhones are bad. From what I hear, iPhones are absolutely great, and I think people will stick with iPhone. I'm just not sure that they will upgrade every single year until something comes out like 5G, but we'll have to wait and see. Either way, I think a lot of this negativity is already being priced into Apple stock, and even though I'm not invested in Apple myself, if we have another couple bad quarters for Apple, we kind of see some sales kind of slow down or something like that, and the stock gets dragged down even more, I don't think I'd be able to resist. I'd probably be looking to jump into Apple stock myself. All right, guys, moving on to stock number 3, we've got United Health Group, ticker symbol UNH. Now, this is another stock that I'm not currently invested in yet, but I'm very bullish on this stock. And the only reason I haven't bought it yet is because I think it's a little expensive. But if it were to drop a little bit in price, if I see a good entry point, I'm definitely buying this stock because it's one that I've definitely had my eye on for a while now. In fact, I recently talked about them in my 3 stocks to buy video for December, and since making that video, the stock climbed by over 3% in that very short time span, but it's currently trading at around $269 per share. Now, their dividend yield is pretty low at only around 1.3%, but they have a decade of dividend growth with almost a 30% 5-year growth rate that is very impressive, and an equally impressive payout ratio of just 28%. So these dividends are very likely to grow in the future. And when looking at their stock price, this is a stock that has performed very well and has been very stable over time. It's up over 260% in the last 5 years and up over 22% in 2018 alone. And a major reason for that is because of the type of business that they have. They offer healthcare related services to payers, care providers, companies, employers, and even the government. And on top of offering healthcare plans and pharmacy services, they've also invested billions of dollars a year to build up their healthcare related technology that even goes as far as to use artificial intelligence, machine learning, and blockchain technology to improve both the efficiency and the security of their healthcare related services and associated big data. On top of that, this is a company that is firing on all cylinders, having gained an additional 2.8 million more customers year over year this past quarter, and it grew to almost 50 million people total. They also saw revenue increase by double digits at almost 13%, and EPS was up another 28%. So with record low unemployment leading to more companies offering healthcare plans to their employees and an aging baby boomer population, I think United Health Group is definitely a stock to watch, not just in 2019, but beyond that, and it's a very good dividend stock as well. Okay, next up, we've got stock number 2, and this is a stock that I am currently invested in, and this is a semiconductor stock. And the thing about these semiconductor stocks, it can be a little risky sometimes, these risky kind of tech stocks, they can be a little cyclical as well. And whenever we have market volatility, whenever we have a kind of market crash, things like that, these kind of stocks get absolutely hammered. So if you see a stock like this get hammered, you may want to consider it. And if this stock drops significantly in price, I will definitely be unloading a truck on it in the near future. But this company is called Taiwan Semiconductor, and their ticker symbol is TSM. Now, despite being a dividend growth stock, their dividend yield is actually really nice at over 3.5%. Their payout ratio is a little high at 60%, but their 5-year growth rate is really good at 18%. But they do only have 4 years of growth, but that's because they just started paying those dividends recently in 2013. Now, when looking at their share price, this is a stock that was performing very well, up over 100% in the last 5 years, but they took a plunge in 2018, mostly because they do a lot of their business in China and investors got spooked because of the whole trade fight that's going on. So the stock is actually down over 20% from their 52-week high. On top of that, TSM makes the processing chips for Apple's iPhones, and with slower smartphone growth being projected, that is only hurting TSM in the short term. Now, I should probably say what kind of a company this is. So this is a foundry, so they manufacture these semiconductor chips. Now, all of this short-term negativity may actually end up being a good opportunity for you if you're a long-term investor. See, TSM is the first foundry to manufacture the 7nm chips that are actually going to be used for AMD, which everyone is going so crazy over. On top of that, TSM is already working on 5nm chips that could be ready as early as 2020, so they're likely to be well ahead of any competition when it's all said and done. Keep in mind that Intel is still operating at 14 nanometers and is barely going to be pushing out 10 nanometers sometime in 2019, with their 10 nanometer server chips pushed even further to 2020, which leaves plenty of room for AMD's chips built on TSM's 7 nanometer technology to steal market share away from Intel. And as far as the trade fight goes, that may bring down the stock a little bit further in the short term, but I do think that this is something that gets solved eventually and we move past it. And even looking at TSM's CEO, he had this to say about the whole deal. He said, "For the short term, we did not see any impact, if there's any at all. So our China customers, no, they did not change their behavior. TSMC has been proud to be everybody's foundry, so if there's trade tension and if it continues, the impact to TSMC would be less or minimized." Either way, like I said, I think a lot of this negativity drags the stock down even more in the short term, but as a long-term investor, if I'm looking at these lower prices, I'm definitely picking up more TSM stock in the near future. I think it's a really good dividend growth stock with that 7 nanometer and even 5 nanometer technology in the future being potential growth catalysts as well. Okay, and finally guys, we've got stock number 1, and this is actually my number 1 largest stock in my entire portfolio. I could not be any more bullish on this stock. I love this stock as a long-term investment. I have so much confidence in this stock and I really want to pick up more. On any dips, I'm constantly buying more of this stock, and that company is Disney. Their ticker symbol is DIS. Now their yield is very low at just over 1.5%, but they have almost a decade of growth, a 5-year growth rate in the double digits at over 16%, and a very low payout ratio of less than 25%. So this dividend is likely to increase more in the future. Now looking at their share price, I feel that this is a stock that is valued at a very good price in my opinion. Yes, they're up over 50% in the past 5 years, but they're only up less than 5% in 2018 thanks to all of this market volatility, and their PE ratio is very low at only 13. Compare that to their soon-to-be competitor in Netflix, who is trading at a PE ratio of almost 100. That is an insanely large gap. And the reason I mention Netflix is because despite Disney having so much more to their business, including world-class resorts, theme parks, and a massive movie studio, they're now planning to tackle Netflix in the video on demand market with their new Disney branded service called Disney Plus that will feature Star Wars, Marvel, and other Disney branded content. On top of that, they have an enormous pool of content and IP that they acquired from 21st Century Fox to bolster their Hulu and Disney Plus platforms with even more options for consumers. And when looking at their most recent quarter, Disney reported revenues up 12%, net income up 33%, and EPS up 37%, even beating analyst estimates. So this is a company that is already performing very well right now, and with the recent acquisition of those Fox assets, they're going to be tackling Netflix in that market. I know I'm definitely signing up for that Disney Plus service because I love Star Wars, I love Marvel, and I know there's a lot of people out there that love that content as well. Not to mention everybody that has kids that will want all the Disney branded stuff. And not to mention that there's also Hulu as well. And Hulu is actually seeing some growth as well. I got into Hulu in some other videos. But anyway, with all that being said, I think Disney is a really good company that is performing well. And they also have a very nice dividend to go along with it. Okay, guys, now before we finish the video, I do just want to give some honorable mentions, starting with IBM. So their ticker symbol is IBM. They have a yield of over 5%, a good payout ratio of 45%, double-digit 5-year growth rate at over 12%, and 19 years of growth. They also just recently acquired Red Hat, which makes them a pretty interesting stock to look into, and I think I'm actually going to make a video on them in a couple days, so make sure you're subscribed for that video. Kraft Heinz is up next. They have a very nice yield at over 5% and a 5-year growth rate of 37%, but a high payout ratio of almost 70% and only 6 years of growth. And their stock performance could be a little bit better as well. Starbucks is up next. They have a reasonable yield at above 2%, a reasonable payout ratio of 54%, very good 5-year growth rate at over 23%, and almost a decade of growth. Okay, next up here we have Coca-Cola. So I talked about Pepsi earlier. Here is their rival Coca-Cola. They have a very nice yield at above 3% and a massive growth history of 56 years of growing those dividends. But their 5-year growth rate is a little low at 7.7%, and their payout ratio is pretty high at almost 75%. And honestly, I just really like PepsiCo a lot more than Coca-Cola, and I think they're a little bit better diversified as well. Okay, next up here we have International Paper. I recently talked about them in one of my videos. Their ticker symbol is IP, and they have a very nice yield of almost 4.5%. They have a good payout ratio of 37%, double-digit 5-year growth rate at above 11%, and 8 years of growth. And the reason why I like IP is because they're really being hammered by the whole trade fight with China. But if that trade fight ever gets resolved, I think IP will be a really good stock to own. So I kind of like them at these prices. And then finally, we have the very controversial Ford stock, but I couldn't make this video without mentioning them because so many people leave comments about Ford stock. They have a massive yield of almost 7%, a good payout ratio of about 45%, a great 5-year growth rate of over 25%, and 6 years of growth. I personally have no interest in investing in Ford. I don't really believe in them, but their dividend is pretty nice, and a lot of people leave comments about them, but it's not a stock that I would recommend to anybody, not really a stock that I believe in. Okay guys, I think that just about does it. I don't mean to sound so bearish on Ford. I know some people are very bullish on it. Just personally not a stock for me. Anyway, I hope that you enjoyed the video, and if I left any stocks out that you wanted to be mentioned, make sure you let me know in the comment section. Maybe I can make another video a little bit later in the future, and I can include some more stocks that maybe you guys mentioned, and I can give my opinions on them and things like that. But if you'd like to see that, make sure you hit the like button. And if you want to support the channel, all I ask is that you hit that like button. It really helps me out more than you could ever know. And I really appreciate all the support, guys. Thank you for watching. I hope you all have a wonderful, beautiful day and that you take care. Bye-bye.